Welcome back to Financial Market Insights for Traders. I'm Sophia, and in today's episode, we are diving deep into one of the most important assets in global finance and macro investing: gold. Gold is one of those assets that almost everybody recognizes, but very few investors truly understand. Some people believe gold is always an inflation hedge. Others think it only matters during recessions or financial crises. And then there are investors who dismiss gold entirely because it doesn't produce income or cash flow. But the reality is far more interesting and far more nuanced. Gold has played a central role in financial systems for thousands of years, and even in modern markets dominated by technology stocks, digital assets, and algorithmic trading, gold still remains one of the most closely watched macro assets on the planet. Today we are going to explore gold's role in a macro portfolio, how a successful gold macro strategy actually works, and perhaps most importantly, when gold works and when it doesn't. Because understanding the conditions that drive gold prices is critical for traders, investors, and anyone trying to navigate changing economic environments. So let's get into it. First, we need to define what a macro portfolio actually is. A macro portfolio is built around major economic and financial trends rather than individual companies or sectors. Macro investors focus on the big picture. They analyze inflation, interest rates, currency movements, central bank policy, economic growth, government debt, commodities, and geopolitical risk. Instead of asking questions like, will this company beat earnings next quarter? Macro investors ask, what happens if inflation remains elevated? What happens if central banks cut rates? What happens if the dollar weakens? What happens if recession risk rises? And gold becomes incredibly important in this framework because gold responds directly to many of these macroeconomic forces. Unlike stocks, gold isn't tied to earnings growth. Unlike bonds, gold doesn't pay interest. Unlike real estate, gold doesn't generate rental income. Gold is different. Its value comes largely from its role as a monetary asset, a store of value, and a form of financial insurance during periods of uncertainty. That's why gold often becomes attractive during periods of inflation, currency debasement fears, banking instability, geopolitical conflict, economic uncertainty, negative real interest rates. Now, one of the biggest misconceptions in financial markets is the idea that gold simply rises whenever inflation rises. That's not always true. And this is where understanding real interest rates becomes extremely important. Real interest rates are one of the most important drivers of gold prices. A real interest rate is simply the nominal interest rate minus inflation. So, for example, if bond yields are 3% and inflation is running at 5%, real yields are negative 2%. And historically, gold tends to perform very well when real interest rates are low or negative. Why? Because investors are losing purchasing power by holding cash or bonds. If inflation is higher than the yield investors receive on safe assets, then money sitting in bonds or savings accounts is effectively losing value over time. In those environments, investors often look for alternative stores of value, and gold becomes more attractive. This is a key principle in any serious gold macro strategy. Gold performs best not simply during inflation, but during periods where inflation rises faster than interest rates. That distinction matters enormously. Now let's talk about when gold works particularly well. One of the strongest environments for gold is during periods of persistent inflation combined with loose monetary policy. History gives us several examples. The 1970s are probably the classic case. Inflation surged, oil prices exploded higher, confidence in fiat currencies weakened, and gold experienced one of the strongest bull markets in history. More recently, after the massive stimulus programs following the global pandemic, inflation accelerated sharply across developed economies. Investors once again began looking toward gold as protection against declining purchasing power and monetary debasement. Gold also tends to work well during periods of financial stress and systemic uncertainty. Think about events like the 2008 global financial crisis, sovereign debt concerns in Europe, regional banking instability, geopolitical conflicts, major equity market sell-offs. During periods like these, investors often move capital away from risk assets and into defensive assets perceived as safe havens. And gold historically benefits from that behavior. Now, it's important to understand that gold doesn't always rally immediately during crises. Sometimes investors initially sell gold to raise liquidity during sharp market stress. But over time, as central banks respond with stimulus, rate cuts, or liquidity injections, gold often strengthens. Another important driver for gold is currency weakness, particularly weakness in the US dollar. Gold and the dollar often share an inverse relationship. When the dollar weakens, gold becomes cheaper for international buyers. Demand may increase globally. Investors seek alternatives to fiat currencies. This relationship becomes especially important because the US dollar remains the world's reserve currency. When confidence in the dollar weakens or when investors expect looser monetary policy from the Federal Reserve, gold often benefits. And then there's another structural trend that has become increasingly important in recent years: central bank gold buying. Many central banks around the world have been steadily increasing gold reserves. Why? Because countries increasingly want diversification away from excessive dependence on the US dollar-based financial system. Gold provides a politically neutral reserve asset that cannot be printed by governments. This institutional demand has become a significant long-term support for gold prices globally. Now let's shift to the other side of the discussion, because understanding when gold doesn't work is equally important. Gold is not a magical asset that rises in every environment. There are periods where gold can underperform significantly. One of the most difficult environments for gold is during strong economic growth combined with rising real interest rates. When economies are expanding strongly, corporate earnings rise, investors become more optimistic, risk appetite improves, equity markets tend to attract more capital. In these environments, investors often prefer growth assets over defensive assets. Why hold gold when stocks are producing strong returns and economic momentum is positive? This is why gold may lag during extended bull markets in equities. Another difficult environment for gold occurs when central banks aggressively tighten monetary policy. For example, inflation begins falling. Interest rates rise sharply. Bond yields move higher than inflation. This causes real interest rates to rise. And when investors can earn attractive real returns on bonds or cash, the opportunity cost of holding non-yielding gold increases. This is one of the most important concepts investors need to understand. Gold competes with real yields. If real yields are deeply negative, gold often looks attractive. If real yields rise substantially, gold may struggle. This is why gold can sometimes disappoint investors even during periods of elevated inflation if central banks remain highly aggressive. And then there's the role of the US dollar again. A very strong dollar environment can create pressure for gold prices. A stronger dollar usually reflects higher US rates, stronger capital inflows, relative economic strength. Because gold is priced globally in dollars, a stronger dollar can reduce international purchasing demand for gold. Now, despite these cycles of outperformance and underperformance, gold still plays an incredibly valuable role in portfolio diversification. And this is where many institutional investors focus their attention. Gold often behaves differently from stocks and bonds, especially during periods of stress. For example, stocks may decline during recessions. Bonds may struggle during inflationary periods. Gold may provide stability when both asset classes come under pressure. That diversification benefit alone is one of the main reasons many macro investors maintain some exposure to gold even when they are not aggressively bullish on prices. So the next question naturally becomes, how much gold should investors actually hold? There's no perfect answer, but many diversified macro portfolios allocate somewhere between 5% and 15% to gold depending on risk tolerance, inflation expectations, economic conditions, portfolio objectives. Some investors treat gold as permanent portfolio insurance. Others use tactical exposure, increasing or reducing allocations depending on macroeconomic conditions. Now let's quickly discuss the different ways investors gain exposure to gold. First, there's physical gold itself. Physical bullion offers direct ownership and removes counterparty risk. Many long-term investors value physical gold for wealth preservation. But physical gold also involves storage, insurance, and liquidity considerations. Then there are gold ETFs. Gold exchange traded funds have become extremely popular because they provide convenient access to spot gold exposure without requiring physical storage. They are liquid, efficient, and widely used by both institutional and retail investors. And finally, there are gold mining stocks. Mining companies offer leveraged exposure to gold prices because rising gold prices can significantly boost mining profits. But mining stocks also carry additional risks: operational issues, political risks, management execution risks, equity market volatility. So mining stocks often behave differently than physical gold itself. Now looking ahead, gold's role in macro investing may actually become even more important. Why? Because many of the structural forces supporting gold remain in place: rising global debt levels, persistent inflation risks, currency concerns, geopolitical fragmentation, central bank reserve diversification, questions surrounding long-term fiat currency stability. At the same time, investors must remain realistic. Gold will still experience periods of underperformance depending on interest rates, growth conditions, and monetary policy. That's why the best investors avoid emotional narratives and focus instead on macroeconomic drivers. The most effective gold macro strategy is disciplined, flexible, and based on understanding the broader economic environment rather than blindly assuming gold always rises. And ultimately, that's the key lesson from today's episode. Gold is neither perfect nor useless. It is a highly environment-dependent macro asset. When gold works, and when it doesn't, comes down largely to real interest rates, inflation trends, central bank policy, currency strength, economic growth, investor confidence. When used properly inside a diversified macro portfolio, gold can provide inflation protection, crisis hedging, portfolio diversification, long-term wealth preservation. And for traders and investors looking to build and execute macro strategies using a world-class, cutting-edge, and user-friendly trading platform, make sure to check out crystalballmarkets.com/platform. And if you want more beginner-friendly insights into trading, investing, macroeconomics, and financial markets, be sure to listen to the educational content available at iss.com/podcast/crystalballmarkets. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.